unless you generally, if you're seen as the controller of, because it's very hard to go through the trust, except if it's like family law, they can do anything they want. It's very hard to go through the family trust. They look at whether you're the controller. By the very nature that you can distribute to companies, you can distribute to bloodline and all that. If you're not that family protection appointor, the leading member appointor, then you're clearly not the controller. So if you do get into a bit of strife, then you simply jump out as the leading member appointor and also no longer a director on that corporate trustee. Now, what we've got a special purpose corporate trustee because the issue I talked about, remember the shares can be exposed. So what we've got there is if you've got a leading member appointor, then they're the only shareholder of that trustee company. Now, when they pass away or they resign or they just want to get out of it or incapacitated, then they resign or they get replaced as the leading member appointor. The next person comes in, but at the same time, the next person comes in is automatically appointed as a director of the trustee company if they're not there already. Plus, the shares of the prior leading member appointor are cancelled and new shares are then issued to the next one. So we don't get anything caught up in the estate. So again, it's better than the successor director solution because the successor director solution still leaves the shares hanging, whereas this leading member of family protection trust makes sure that there's an orderly transition that happens just like that. And the good thing about trust is if that's where your wealth is, you can, if someone passes away, you can actually pay straight away out of that trust. Funeral expenses, looking after the family, nothing should change. It's just simply the appointor and the trustee carries on. That's why it's important to have someone like Ben who can get in there and get involved straight away and reshape and recalibrate things and make sure that everyone's cash flow needs are looked after. Whereas if it goes into the estate, it can be a perilous situation for years on end.
Yeah, absolutely. And then for our clients, like we've obviously got, like, there's massive benefits for sitting wealth inside of super, but for the wealth that's held outside of super, this is kind of our preference is to keep most of it here or all of it. And it's almost in a way like a second super fund.
Yeah, I look at it because, I love my super. Obviously, I've written all the books on it. So, I like doing it. But as you get a little bit older, the danger is that if one of the elderly couple dies, that we might end up with, just too much money in super, if that makes sense, because you only really need enough in there. So there's two ways of doing it is when you set up an income stream, again, this is probably the best way around a contested will, so that if you're setting up an income stream, it might go from yourself to your spouse and then to your children. Your children can't take an income if they're over 25 unless they're disabled. They can still take it as a lump sum so that it pass the parcel, which is useful. You can even set it up if you're paying the grandkids' school fees. You have an income stream that goes grandpa, grandma, grandkids if you want. And that's very tax effective because the money stays inside the super fund. I've already said it's not able to be accessed by a trustee in bankruptcy. But if grandpa was on tax-free super because he's over 60, then the grandkids, even if they're 4, 5, 10, 15, it's also tax-free super for them. So that's a great way. But as soon as you die, it automatically passes over to the next person. So that means it can never go into the estate because that part of property just evaporates on death. So that's one of the best ways of doing it with super. But as I said, you might end up having one of these and then at the same time, because there are limits on what you can have by way of an income stream or a pension out of your own self-managed super fund. So you might end up with a large amount sitting in an accumulation account. The danger about that one is that when those monies are passed out, unless it's been monies that you put in that are non-tax friendly or been actually after-pocket monies going in, or what we call non-concessional contributions. Anything over and above that, when it comes out, is taxed at 17%. But if that's backed by a whole lot of assets, so you have to wind up that person's estate that's reflected in some of those assets, you might be up for capital gains tax of 10% plus another 17% going out. So I'd go back to you at some point in time. It makes sense that you run with your super because it is tax effective, but potentially pull your super out, the stuff you don't need to generate that income stream or that ongoing income stream, and then put it into a leading member discretionary trust. So settle it in there and then start to build your estate planning because there's no tax on the way out.
Yeah.
I said when you die, but anyway.
Yeah, and you've even got a solution that may help that what you just mentioned as well, that 17% tax. But
exactly.
We've been